Welcome, everyone. Today, we will walk through the K-market microstructure and our 24-hour dynamic chain forecast for June 22nd, 2026. We're currently navigating a highly complex market regime, characterized by extreme divergence between global macro shocks and hyper-concentrated micro-momentum. Let's dive into the data. We declare the current market regime as a structural collision. On one side, we have escalating geopolitical macro risks. On the other, relentless micro-level semiconductor demand. We have identified three dynamic chains driving today's session. Chain A, driven by Middle East geopolitical triggers. Chain B, fueled by the global AI semiconductor supercycle. And Chain C, focusing on localized retail sentiment and institutional rebalancing. Let's look at Chain A. Following the delayed U.S.-Iran talks and the announced closure of the Strait of Hormuz, we are witnessing significant upward pressure on oil and the U.S. dollar. The USD to KRW NDF exchange rate has spiked to 1,527 won. This elevated FX level is acting as a primary macro headwind, directly suppressing foreign spot buying in the broader Korean market. However, Chain B presents a stark contrast. Global smart money continues to aggressively accumulate AI assets. Last week, U.S. equity funds saw a record-breaking $119 billion in inflows. For the K-market, this translates to hyper-focused liquidity on the semiconductor value chain, driven by upcoming catalysts like Micron's earnings and the imminent approval of SK Hynix's US ADR. Moving to Chain C, we must address the K-market's unique microstructure. As the KOSPI briefly breached the 9,000-point threshold, we observed massive retail buying, totaling 3.1 trillion won. Conversely, institutions are executing heavy, mechanical half-year rebalancing sell-offs. This dynamic is creating severe bipolarization between large-cap tech and the rest of the market. Currently, the K-market is split into distinct phases. Large-cap semiconductors are in Phase 3, reevaluation. Despite short-term foreign selling, robust fundamental demand is providing strong downward rigidity. On the flip side, the KOSDAQ and small caps are in Phase 2, initial shock. Retail FOMO has quickly turned into FUD, fear, uncertainty, and doubt, leading to capitulation and decoupling from global tech rallies. Our quantitative momentum score stands at 75 out of 100. This indicates a high-noise, high-volatility environment. The macro penalty is nearing its critical threshold due to the 1527 won exchange rate, while supply-demand factors are heavily skewed by extreme retail herding. In short, noise traders are currently dominating intraday volatility. This brings us to a critical divergence. Last Friday, retail investors chased intraday highs, while smart money, foreigners and institutions, offloaded a combined 3 trillion won. This backwardation pressure indicates that smart money is taking profits and hedging against macro risks. For quantitative investors, this retail capitulation in the KOSDAQ presents a contrarian opportunity. Applying our Bayesian updating model with a T-1 volatility penalty, we assign a 50% probability to our base scenario, a sideways convergence with KOSPI moving between negative 0.5% and positive 0.2%. The bull scenario sits at 25%, contingent on the SK Hynix ADR approval triggering a massive foreign inflow. The bear scenario is also at 25%, triggered if Hormuz tensions push oil and FX past critical resistance. Finally, our actionable plan. We recommend an overweight position in AI semiconductors to capture the structural growth, alongside defense sectors as a geopolitical hedge. We maintain an underweight position on marginal KOSDAQ firms due to FX pressures and rebalancing risks. Given the extreme macro noise, we advise maintaining a 35% cash position and preparing a 15% active short hedge if foreign future selling accelerates at the open. Thank you.